There we go, everyone. Thanks for joining me. I do have a very special guest today. I'm excited to bring him in, but first, as a reminder, I'm Rob Tatro from robtatro.com, portfolio manager here at Canaccord Genuity Wealth Management and at the Tatro Wealth Advisory Group. Really excited with our guest. I'm going to bring him in right away here. None other than, I call him KV, but Kevin Vandermeer. He's a CFA. He's a fellow of the Canadian Securities Institute. He's also managing director, investments and advisory solutions at Canaccord Genuity Wealth Management. Kevin, thank you so much for joining us and welcome.
Thank you for having me, Rob. And it's great to be.
I'm going to take you through the next slide here. It's titled "Sitting in Cash."
Yeah. So a lot of people have a sense that, look, because the market dropped so quickly and then bounced back so fast, and because many of us, weren't around for the Spanish flu, which was the last pandemic in 1912 or so. Most of us that are professionals have never been through a pandemic. We've been through lots of recessions. So there's still a lot of uncertainty in terms of the economy, even though we can see that the economy is improving. But there's still a lot of cash on the sidelines. If you're listening to this show and you're saying, I've missed this bounce and I'm still sitting in a lot of cash, well, know one thing for sure, and we'll get to some of the things that we think you should be doing with the cash later in the show. But just recognize that there's a lot of people that are also sitting in cash. And as somebody who's a student of the markets, we would see this as a positive. Why is this a positive that lots of people are sitting in cash? It means that you still have people that need to enter the market, that still need to invest. And obviously, we actually have more cash than we were in 2008. So professional money managers need to start to work this capital back into the market. And that can be one catalyst for why this market can continue to go up, even though, as we just showed you, is up a lot.
Yeah, I think for those of you out there that need to be reminded, the issue of cash is adding buyers, adding liquidity to the market. So the more buyers you're adding to the market, you have more buyers and sellers, your market's moving up, right?
Yeah,
this is a neat chart. I'll take you through here to the next one here. This is the net short position. Maybe before you could just take a quick sec and clarify.
This is a little bit more of a more complicated chart, but there's obviously lots of different people that enter the market. There's retail advisors, people like myself, people like Rob and others that manage money for people. And then there's obviously big institutions. And then there's hedge funds that are going to trying to make money going long the market, so buying the market, but also shorting the market. When somebody shorts the market, they're hoping that the market goes down. So what you're looking at here is a chart where, and it says the bears are back. So bears are people, investors that want this market to go down or a market to go down. So whenever you see the red line here, it means that people are betting or have placed bet for the market to go down. And where you've seen green is where you would expect people are expecting or have put bets down for the market to go up. So right now you can see that it's quite negative. And again, as investors of other people's money and stewards of other people's money, while this might seem very, very negative, we actually see this as a positive because it means that the short sellers or people that are betting that the market needs to go down are going to have to eventually cover their positions. And again, that's more buying power, more people that need to enter the market and either close off their positions or buy in the open market. And so historically, when we've seen these extreme moves or extreme negativeness or the extreme bears, if you will, or people that are betting that the market goes down at these kinds of levels, typically the market will move higher over time. And so this is sort of a, if you will, a harbinger of positive movement over the next 6 or 12 months. And we'll show you a little bit more of that later in the show.
There's, for those of you that don't understand shorts, real briefly, I'll try to just clarify. But basically, if you think a stock is going to drop or the market is going to drop, what you do is you borrow it from an institution, a financial institution, such as Canaccord Genuity or a bank or whatever it may be. You then go out and you sell it, and you are therefore short the market. So you have sold the security, and in our terminology, we would call that being short. You are then hoping that at a future time, you can buy the security back, and you would therefore cover your short, or you would therefore be a neutral position. So you sold 100 shares of SPY, and now you are buying them at a future date. And when you're buying them, you're hoping that the price is going to be lower than what you sold them at. Therefore, you would have sold higher and bought lower. It's the reverse of going long. Now, there are costs associated with this, specifically interest costs, because you're borrowing money to do this. Also, you're borrowing stocks to do this. So you also often have to pay a premium to borrow a security to do this. And remember, your loss is boundless. Your potential loss is boundless, because what happens if that stock starts going up, at some point you have to cover your short. And if you're on the wrong side of that trade, it's not pretty, ladies and gentlemen, because then you're buying at a much, much higher rate. And we've all seen the world famous short squeeze, where the short people are trying to cover a short and you just get squeezed out. So squeezed out meaning the price goes higher and there's nothing left for you to sell. That's hopefully in a nutshell made a little bit of sense to you. Kevin's point here is that the shorts are back, and that means people will have to buy securities to cover their shorts. Very, very good chart, Kevin. I'm going to take you to the next slide here, Kevin. This is the bull market analogs for the American market.
Yeah, so this is a really interesting chart. So we've talked about the market pulling back. We've talked about the market bouncing and really having this really, really strong move off the bottom. So what you should be asking yourself is, okay, what next? Where is this market going? And so this is some work that was done by Fidelity, just some really great work on the US market. And basically it said, after we've had this big bounce, and it's called the first breath peak. So you can see how they've lined up every line and kind of put a pin in all of the markets that have gone up a lot. And then there's kind of this kind of where it takes a breath or a breather. And any of these rallies have kind of paused and pulled back a little bit. Very natural. But as we can see, most of these lines, and again, the work that they've done goes back to the 30s. So again, we're looking at markets where you've had this severe pullback. So you'd expect kind of a recession or a market correction kind of every 5 years. So I think there's 20 scenarios there. But you can see over time, and this is kind of how markets kind of repeat or rhyme, each one of these recessions happen for a different reason, but you can see over time markets tend to recover. And so really what we're trying to identify here is that if you are sitting on cash, if you just went through this big roller coaster and you're like, get me off, or feel like you've missed the whole move off the bottom, what we're trying to highlight here is that we think 6 months or 9 months from now, or even a year from now, on whole, markets will be higher. And we have a lot of confidence in that because we're looking at 20 scenarios in which that happened before.
I like that. I like using a lot of data. And if you've been watching my show for a while, you've heard me talk about this. I talked about it on March 23rd. I talked about it right at the bottom there. I was saying, when these things happen, they always bounce back. Now, this is a neat analogy. This is a little different than just, hey, markets fall and markets come back, because you've added the research piece about the first breath, where there's kind of like that one peak. And, we did touch on that a couple of weeks ago. So I do like this. I do think it's very valuable data, and we've seen 20 times. And of those, I think there's one negative market, and it was 1929, I would imagine.
That's right. Yeah, I think there's maybe two, or there's a couple that are just a push, but sort of like whether you want to say 17 or 16 times out of 20, those are really good odds. And what we would say on top of that is that the Federal Reserve in the U.S. has put more money into this pandemic, more money into the economy than ever has before. If we were just looking at each one of those scenarios, you have, let's call it 16 out of 20% chance the market will be higher. And then what we do is we adjust that probability probably a little bit higher, because the amount of stimulus that's been put to work in this market to support it is greater than any other time in history, which I think only further benefits our upside case scenario. Then, as we've talked about, layer on the fact that people will still have cash, layer on the fact that we have very sophisticated hedge funds that are short this market. All of that would suggest there's kind of this positive support under this market. And so you go back to last week, a weak market. Today, we're kind of recovering much of what we lost on Friday.
Hey, I'm going to put you on the spot. Hopefully you don't mind. If you've obviously followed Javed quite closely, Javed Mirza, he's been on my show a couple times here in the last while. He sent out a note yesterday, I think on Sunday, but 2 weeks ago, he was on our show. He was talking about a kind of short-term correction, 5 to 10-ish% perhaps. He was pretty much spot on exactly in the next couple of weeks, he had said. Yesterday, he sent there's potential intermediate range of a downside, maybe 5% exposure in the near term here. What do you think about that? And I know you don't look at short term, because you and I think alike. It's long term, or at least medium term. But Javed looks more at short term. What are your thoughts on that comment by Javed?
What you need to do is understand that Javed writes a lot of his research, the work that he does, very good, very technical, but also tends to be very short term. So keep in mind, he's publishing weekly. He's on a conference call with advisors like yourself, Rob, as you know, and his focus primarily is on institutional investors and giving them guidance on what to do with large pools of money. So he tends to think in kind of 1 to 2 to 3 weeks. So when he talks about a pullback in the market, in many ways we've already seen it, but the summer months are a little bit quieter. And the reason is you have people obviously away on vacation. It's not unusual that in the summer the market will go sideways or even drift lower. And so I think that's part of what his comments are, is that, you know what, understand the fact that the market could go sideways or down a little bit. But as we think about being custodians and stewards and guiding people with their retirement or helping people save for their children's education or for a home, we tend to think longer term and a little bit further out. So rather than trying to kind of negotiate every corner like institutional investors are required to do, we want people to think a little bit longer term. And so that's really what we're trying to do. I see that you put up the chart here of Canada. So this is
and you know what? Just one more point on Javid. I don't want to let this one go. Is that what I was going to add? And I thought you might say is that largely we're on the same page because he's bullish. Yes. He thinks like all-time highs this year for the S&P 500, and he thinks we're in a secular bull market here. And you know, he might see a little blip in the next week or two. But if he were here right now, he'd say like, just buy anyways, because we're going to be up at the end of the year, right? We're going to be up next year as well. He would say he's extremely bullish. Yeah. So I think you and him think extremely alike. You and I just worry less about the short-term, week-to-week fluctuations.
That's right.
We care more about the long-term.